Imagine if one of Asia's pioneering budget airlines vanished virtually overnight. For nearly 2 decades, Jetstar Asia's orange-starred jets were a familiar sight at Singapore's Changi Airport. Yet in mid-2025, its parent company Qantas announced that Jetstar Asia would cease operations completely. What happened to Jetstar Asia, and why did Qantas pull the plug on this 20-year-old low-cost carrier? Jetstar Asia launched in December 2004 amid a boom in low-cost air travel across Asia. It was established as a joint venture between Australia's Qantas Airways, holding 49% ownership, alongside private investors. From the start, Jetstar Asia was designed to be a low-cost carrier, LCC, based in Singapore, tapping into regional demand for affordable flights. The inaugural flight took off for Hong Kong on the 13th of December 2004, marking the beginning of an ambitious expansion. By mid-2005, Jetstar Asia had already begun consolidating the market. It took over a smaller rival, Valware, in July 2005, merging operations under a holding company called Orange Star. This early merger gave Jetstar Asia a stronger foothold and route network in Southeast Asia. The airline rapidly grew its fleet from the initial 4 leased Airbus A320s to 8 aircraft by mid-2005 and continued expanding toward a fleet of over a dozen jets. With backing from Qantas and Singaporean stakeholders, Jetstar Asia set its sights on connecting Singapore with major cities across the region at rock-bottom fares. In its first several years, Jetstar Asia benefited from Singapore's liberal aviation policies and growing demand. By 2010, the airline had captured over 27% of Singapore's LCC market, at the time rivaling the market share of Tiger Airways, the budget arm of Singapore Airlines. Jetstar Asia was essentially tied for the position of Singapore's largest budget carrier in 2010. A remarkable achievement for a newcomer. It built a reputation for no-frills service with cheeky marketing and steadily grew its route network across 16 regional destinations. The future looked promising, and Qantas touted Jetstar Asia as the most profitable and best low-cost network based in Singapore at one point. Despite early successes, Jetstar Asia's journey was not without turbulence. One major turning point came around 2011 to 2012, when global fuel prices spiked dramatically. Oil prices broke record highs above $100 per barrel, driving up the cost of jet fuel, the biggest expense for any airline. Jetstar Asia's financial performance took a hit. Profits plunged by 80% in the financial year ending June 2012 as fuel bills soared and competition intensified. The airline's fuel costs shot up to 214 million Singapore dollars from 128 million Singapore dollars the previous year, erasing much of its earnings. This sudden profit collapse revealed how vulnerable the budget carrier was to external cost shocks. Another key turning point was the entry of new competitors in the marketplace. In 2012, Singapore Airlines launched Scoot, a low-cost subsidiary operating medium-haul routes with larger aircraft. Around the same time, Air Asia, the Malaysian budget carrier powerhouse, was expanding aggressively in Singapore and Southeast Asia. Jetstar Asia found itself squeezed between Scoot, backed by Singapore's flag carrier, and Air Asia, the region's largest LCC group, along with smaller players like Tiger Air, which Scoot later absorbed, and Indonesia's Lion Air. By the late 2000s and 10s, Scoot's growth far outpaced Jetstar Asia's. Scoot operated dozens of destinations with a growing fleet, 45 aircraft by 2018, making it more than twice the size of Jetstar Asia. Jetstar Asia, once equal to Tiger Air, slowed its expansion and saw its market share steadily erode. A significant corporate turning point occurred in the mid-2000s and 10s when Qantas's strategy began to shift. Qantas had originally envisioned Jetstar Asia as part of a broader Asian growth plan. It even attempted a Jetstar Hong Kong venture that failed to launch due to regulatory hurdles. However, faced with intense competition and thin margins in Asia, Qantas grew more conservative. Jetstar Asia never expanded beyond short-haul routes and about 18 aircraft at its peak, while other Jetstar-branded ventures, like Jetstar Pacific in Vietnam, struggled or rebranded. By 2018, industry analysts noted that Jetstar Asia had no plans to resume expansion, effectively ceding growth to Scoot and others. This marked a strategic inflection point. Jetstar Asia was transitioning from a growth story to a stagnant player in Singapore's aviation market. Finally, the most consequential turning point was the COVID-19 pandemic in 2020. The pandemic was an unprecedented shock that grounded global aviation, and Jetstar Asia was no exception. We'll explore its impact in detail in a later section, but it's important to note here. COVID-19 effectively set the stage for Jetstar Asia's ultimate downfall by halting its operations and exacerbating its financial and competitive challenges overnight. One of the core reasons behind Jetstar Asia's closure lies in escalating costs. In the years leading up to 2025, the airline's cost base skyrocketed, undermining the low-cost model it relied on. Qantas Group's CEO, Vanessa Hudson, highlighted that some of Jetstar Asia's supplier costs had increased by up to 200% in recent years. These supplier costs include things like maintenance contracts, ground handling fees, and aircraft leasing expenses. Essentials that became far more expensive, eating away at Jetstar Asia's thin profit margins. We have seen some of Jetstar Asia's supplier costs increase by up to 200%, which has materially changed its cost base, Hudson noted, underscoring how unsustainable the situation had become. Airport fees and regulatory charges in Singapore further piled on the pressure. Changi Airport, while renowned for its efficiency, is not a cheap hub to operate from. In fact, Jetstar Asia publicly warned that rising airport charges at Changi could force it to raise fares by 10 to 25%, potentially hurting demand. The airport announced successive fee hikes to fund expansion, like the future Terminal 5, meaning airlines and passengers had to pay more. Jetstar Asia, whose model depended on ultra-competitive fares, with 80% of its tickets under $100 according to one report, was squeezed by these higher fees. The carrier stated that escalating airport charges put unsustainable pressure on its ability to offer low fares, essentially striking at its core DNA. Furthermore, regulatory constraints limited Jetstar Asia's flexibility. As a Singapore-based airline partly owned by a foreign company, Qantas, Jetstar Asia had to navigate ownership rules and bilateral traffic rights. While Singapore's skies are relatively open, Jetstar Asia couldn't, for example, easily operate beyond Southeast North Asia without traffic rights via Singapore. Plans to fly longer routes or open new bases were constrained. Contrast this with Air Asia, which sidestepped such issues by setting up affiliate airlines in multiple countries, or Scoot, which enjoyed Singapore Airlines' home advantage. Jetstar Asia remained a single-country airline, exposed to local cost structures and regulations without the same economies of scale as its multi-base rivals. The lack of a domestic market, Singapore is just one city, meant it depended entirely on international routes, where competition was fierce and subject to government policies, like travel restrictions during COVID. All these factors, surging supplier costs, pricier fuel and fees, and the limitations of its operating framework, combined to significantly raise Jetstar Asia's expenses and limit its revenue, eroding the very cost advantage that an LCC is supposed to have. Jetstar Asia's troubles were compounded by fierce competition that ate into its market share. In the 2000s, it was one of only a few budget airlines in the region. But by the 2010s, Singapore had become a battleground for low-cost carriers. Scoot, backed by the deep pockets of Singapore Airlines, expanded rapidly with new routes and aircraft. By 2018, Scoot commanded about 43% of Singapore's LCC seat capacity, nearly half the budget market, while Jetstar Asia's share had shrunk to under 20%. Scoot was operating more flights to more destinations, aiming for 70 aircraft by 2021, and effectively dwarfing Jetstar Asia's presence. AirAsia and its affiliates, Indonesia AirAsia, Thai AirAsia, etc., were also aggressive. They turned Singapore into a focus city, shuttling passengers through Kuala Lumpur and other hubs with attractive fares. Other entrants like Lion Air, Cebu Pacific, Vietjet, and Tiger Air, before merging into Scoot, all vied for slices of the Singapore market. The result? Jetstar Asia struggled to maintain relevance. Its network of 16 routes from Changi began to overlap heavily with competitors' offerings. According to Changi Airport Group, out of the 16 routes Jetstar Asia flew, 12 of them were also served by other airlines. In fact, 18 other carriers collectively were competing on those same routes with over 1,000 weekly services. In short, almost wherever Jetstar Asia flew, rivals were there too, often with greater frequency or larger planes. This intense competition led to a dramatic market share decline for Jetstar Asia. Around 2010, it had a leading share of the budget segment, but by the eve of the pandemic, its slice of the total Singapore air travel market had dwindled to roughly 6%, and the pandemic would shrink that even further. By 2024, Jetstar Asia carried only about 2.3 million passengers, accounting for a mere 3% of Changi's total traffic. In other words, its share of the Singapore market had been cut in half post-COVID. Competitors not only returned to the skies faster, but also seized the opportunity to grab Jetstar Asia's customers. Singapore Airlines Scoot rebounded strongly with the backing of a national carrier, and AirAsia leveraged its brand and scale to scoop up budget travellers. Jetstar Asia, with a smaller fleet and constrained resources, couldn't keep up. All of this meant that Jetstar Asia was fighting an uphill battle on fares and load factors. To fill its planes, it often had to discount heavily, but competitors could match or undercut fares thanks to their scale or support. The airline was effectively squeezed from the market. A rhetorical question arises. How can a small airline survive when giants are crowding the field and costs are rising everywhere? Jetstar Asia's answer, ultimately, was that it couldn't. At least, not profitably. Its inability to significantly differentiate, everyone offered no-frills service, or to dominate any niche routes left it without a moat. Over time, its branding as part of the Qantas Jetstar family may have even been a disadvantage in the eyes of cost-sensitive travellers who saw AirAsia or Scoot as go-to budget options. This erosion of market position set the stage for Jetstar Asia's exit once a final blow landed, that blow being the pandemic. When COVID-19 struck in early 2020, it was catastrophic for aviation globally, but especially for airlines like Jetstar Asia. Singapore imposed strict border closures and travel essentially ground to a halt. Jetstar Asia suspended all passenger services in March 2020 as countries shut their borders. For months, its aircraft sat idle on the apron. A handful of repatriation flights and cargo services were the only activity. The airline's revenue collapsed nearly to zero during the lockdown period. Jetstar Asia's CEO at the time, Bara Pasupathy, described COVID-19 as the single biggest shock to aviation, one that forced incredibly difficult decisions to ensure survival. Those difficult decisions included major cuts. In June 2020, Jetstar Asia announced it would lay off 26% of its workforce, roughly 180 employees, to conserve cash. The majority of remaining staff were put on extended furlough, unpaid leave, for months. The airline also took the drastic step of removing 5 Airbus A320s from its fleet, nearly 1/3 of its aircraft, permanently grounding them to reduce costs. This reduced the fleet to 13 planes, from 18 pre-pandemic, a clear indicator of downsizing for a long recovery slog. Essentially, Jetstar Asia shrank to half its former operational size during COVID's peak. Even as travel gradually resumed in late 2020 and 2021, Jetstar Asia's recovery was painfully slow. Singapore maintained tight entry rules for an extended period, and when those eased, competition for the limited traveller pool was fierce. Unlike some larger airlines, Jetstar Asia had no domestic market to fall back on. It couldn't fly at reduced capacity on home turf like airlines in bigger countries did. Every route depended on 2 countries' borders being open. Additionally, being a smaller carrier, it lacked cargo capacity or other revenue streams to buffer the downturn. It is telling that even by 2022, Jetstar Asia was operating at well below half of its pre-COVID capacity, in terms of flights and passengers, essentially still in survival mode. It wasn't until 2023 that the airline even approached the 50% mark of 2019 operations, lagging behind regional peers that ramped up much faster. This slow recovery had lasting consequences. Jetstar Asia ceded ground to competitors during the pandemic. When borders reopened, travellers often chose airlines with more frequent service or larger networks. For example, Scoot and Air Asia were quick to restore routes and even add new ones as soon as demand returned. They aggressively promoted sales to capture pent-up travel demand. Jetstar Asia, on the other hand, faced constraints with its smaller fleet and weaker finances. It couldn't immediately bring back all routes or add capacity at will. In the cutthroat post-COVID market, this meant lost market share that would be nearly impossible to regain. Financially, the pandemic left Jetstar Asia in a vulnerable state. The airline incurred heavy losses during the shutdowns and only managed a partial rebound afterward. In fact, as of the 2024-25 financial year, Jetstar Asia was projected to post an underlying loss of 35 million Australian dollars, about 23 million US dollars. It hadn't been able to return to profitability since COVID. This ongoing loss further convinced its parent Qantas that Jetstar Asia was no longer a viable venture under the current conditions. In short, COVID-19 delivered a blow from which Jetstar Asia never fully recovered, accelerating its decline and setting the stage for the strategic exit that was to come. On June 11, 2025, Qantas Airways dropped a bombshell. It announced that it would shut down Jetstar Asia entirely by July 31, 2025. The news marked the end of an era for Singapore's aviation scene. The 20-year-old airline, which had once been a trailblazer for low-cost travel in the region, was now deemed unsustainable. Qantas's statement squarely blamed rising supplier costs, high airport fees and strong regional competition for the decision. Essentially, all the factors we've discussed, cost pressures and stiff competition, had reached a tipping point. Jetstar Asia could no longer deliver returns comparable to Qantas's core domestic and international markets. So the hard call was made to pull the plug. The shutdown plan outlined several immediate impacts. Up to 500 employees in Singapore will lose their jobs as Jetstar Asia ceases operations. This includes pilots, cabin crew, engineers, and corporate staff, a significant hit to Singapore's aviation workforce. Qantas said affected employees would receive redundancy payouts and support, including help finding new jobs either within the Qantas Group or with other airlines. Still, it's a painful outcome. Jetstar Asia's fleet of 13 Airbus A320s will be redeployed to Qantas's operations in Australia and New Zealand, ANZ. This is a critical piece of the strategic rationale. Those 13 jets, once based in Singapore, are valuable assets that can be recycled into markets where Qantas sees better returns. Qantas indicated that by bringing these planes back to Australia, it could avoid costly aircraft leases in its Jetstar Australia subsidiary. In fact, the group estimated about 500 million Australian dollars in capital would be unlocked by reassigning the planes to its core businesses. Instead of Jetstar Asia flying them unprofitably in Singapore, Jetstar in Australia can use them to increase domestic capacity or replace older leased jets, thus saving money. This essentially reallocates resources to Qantas's home turf, where travel demand has recovered strongly and profit margins are healthier. From a network perspective, Jetstar Asia's 16 routes from Singapore will be either discontinued or taken over by others. The airline will run a progressively reduced schedule in its final weeks before the last day on July 31st, 2025. Passengers booked on later flights are being contacted and offered either full refunds or alternative arrangements on other airlines. Changi Airport Group, CAG, expressed disappointment at Jetstar Asia's exit, but acknowledged the commercial reasons. CAG also noted that most routes would still be served by other carriers, minimizing long-term connectivity impact. Indeed, for travelers, the disappearance of Jetstar Asia might be mitigated by Scoot, Air Asia, and others filling the gap with additional flights or new budget offerings. It's worth noting that Qantas is not shutting down the Jetstar brand entirely. This move is specific to Singapore. Qantas affirmed that its other low-cost carriers, Jetstar Airways in Australia and Jetstar Japan, will continue operating as usual. The focus is on withdrawing from a market that was underperforming. Vanessa Hudson, Qantas Group CEO, framed it as a strategic restructure, refocusing on stronger performing core markets. In simpler terms, Qantas decided that the Jetstar model works better in Australia and to some extent in Japan with a local partner, but not in Singapore any longer.